Fixed Income Market Outlook June 2023. Bond yields cool, benchmark 10-year G-Sec drops to 6.99%. Cooling inflation, RBI pausing rate hikes and a stable macroeconomic environment cooled bond yields across the curve. Money market yields saw a sharp drop owing to a jump in system liquidity. In a surprise announcement, the RBI announced a gradual withdrawal of the 2000 rupees currency note. As per RBI estimates, 31,000 crore rupees worth of notes are currently in circulation and are likely to be exchanged by 30th September 2023. India GDP growth for financial year 23 at 7.2%, Q4 growth beats estimates at 6.1%. India retains its tag as the fastest growing large economy with a GDP growth print of 7.2% for financial year 2022 to 2023. The key drivers for growth have been the strong supply side pickup across sectors and a roaring investment-led demand. A culmination of these two factors counteracted a weak external market. The inward-looking nature of our economy has thrived in an otherwise gloomy global economy, furthering investor confidence across the global fraternity, making India a preferred investment decision. Economic activity buoyant, inflation cools, and India achieves current account surplus. PMI manufacturing rose to a 31-month high of 58.2 in May. CPI inflation moderated to an 18-month low of 4.7% in April from 6.4% in February, driven by base effect and a broad-based moderation in prices. Core inflation also moderated to a 2-year low of 5.3% from 6%. The trade deficit narrowed to an 18-month low of $15.2 billion in April from $18.6 billion in March. Considering the merchandise and services trade balance, we impute that the monthly implied current account is tracking at a surplus of $3.3 billion per 1.2% of GDP annualized, assuming steady trend in remittances and investment income. Further, FX reserves have risen $75 billion since October 2022 to $600 billion. Strength in all quarters of the economy indicates a high degree of positivity in the economy. Another US debt ceiling crisis avoided. The House of Representatives in the US approved a deal to allow the US to borrow more money days before the world's biggest economy is due to start defaulting on its debt. The government is forecast to hit its borrowing limit on Monday, 5th June. That has left little margin for error as lawmakers race to avoid the US defaulting on its $31.4 trillion debt, which underpins the global financial system. A default would mean the government could not borrow any more money or pay its bills. It would also threaten to wreak havoc on the global economy, affecting prices and mortgage rates in other countries. Market view. Markets have seen a material rally over the last month across the G-Sec and corporate bond markets, with yields falling between 20 to 30 bps across the curve. Growth has returned to its central place in RBI's framework. With inflation projected to fall below 6% and no mention of the 4% official target of inflation, it appears that RBI is comfortable with its projection of inflation in the coming year. Average inflation is projected at 5.2%. GDP growth was marginally marked up to 6.5% for FY24. The impact of the 290 bps of tightening over the last year is now expected to affect the real economy. The clear emphasis seems to be support for growth unless inflation again surprises above 6% consistently. The withdrawal of 2000 rupees notes has largely been a non-event for the markets. Over the next few months, banking liquidity will likely see some inflows into the system, although much of this impact should be offset by the government borrowing calendar. Coupled with FPI inflows and tax collections, system liquidity has spiked to tilde rupees 1 lakh crore. A flush banking system could add further downward pressure on yields in the near term. The current curve continues to remain flat, with everything in corporate bonds beyond 1 year up to 15 years is available at 6.75 to 7.10% range. We retain our stance of adding duration to portfolios in a staggered manner, given that a large uncertainty driving rates and duration calls is now out of the way. Actively managed portfolios with mid-moderate duration mandates offer compelling investment solutions as compared to traditional savings instruments, given that both assets have parity in tax treatment. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.